Hi everyone and welcome to the weekly update with me, Richard Perry, market analyst at Hansack Markets. Each week I take you through the key events that I believe will be driving your investments in the coming days. And certainly moving into this week, in fact for the last few weeks actually, the strength of the US dollar has been a big story for these markets. Now, this US dollar is now broken out above a key level on the dollar index, taking it to a new 4-year high. And there's a significant amount of data throughout this week that could continue that move. The strength of the US data has been certainly helping to drive this dollar higher, and obviously what we've got coming up this week could well impact that even further. We've got US non-farm payrolls, we've got the manufacturing PMIs, and also consumer confidence, all stateside, but also in addition to a significant amount of other data as well. So this US dollar trade could continue to run this week. Now, on the flip side of that, you've had a slight amount of safe haven flows in the last week or so. That certainly helped to support US Treasuries and also precious metals as well to a certain extent. Precious metals have sort of been consolidating more than rallying, but that has come at the time at which the US dollar has remained very strong. So that's sort of played out in that regard. But certainly, if the airstrikes on Islamic State positions continues, the market could begin to calm down in terms of its state of safe haven asset flows, and that could continue then for the gold price to pull lower again. So it's on a bit of a knife edge at the moment as to exactly which way the gold price is going to go, but certainly it's an interesting one nonetheless. Okay, so where are these forex markets trading at the moment? Well, the euro continues to pull lower. It continues to consolidate to a certain extent, and I spoke about in my morning report today, in fact, that you tend to get between maybe 50 to 100 pips of rally or upside before you get the next decline, and that seems to be continuing to be the case. You see these consolidation periods before the next pull lower. We've now breached below the 61.8% Fibonacci level, around about that $1.2780 level, but also the key July 2013 lows at $1.2750 as well. So the next support is at $1.2660, and if that were to go, then we've not actually got a great deal of support all the way back until $1.2040, which was the beginning of that big rally. You've got a lot of Eurozone data out as well this week. In addition to all that US data, you've got Eurozone data as well. You've got the Euro CPI data, you've got unemployment, you've got the ECB, and also the PMIs as well. So it's a significant amount that could flip this Euro dollar trade around. So a lot of volatility perhaps this week, and needs to be watched. Now, okay, so for cable, we had a bit of a recovery going on, but I think that's now been unfortunately broken down below the support at 62.80 when that breached on Friday. I think that changed the outlook for cable, certainly near to medium term anyway. I think we're now going to see a test of that 61.60 support, and I think that cable is going to come under a bit more pressure again this week. For dollar yen, once again another strong dollar trade. We've had a big consolidation over the last week or so, but that's now broken out to the upside above that 109.45 level, and that actually gave us a 120 pip target on the upside towards 110.65. Coincidentally, that is exactly where the resistance from that August 2008 high comes in. So I think that's exactly where we're going to be going on dollar yen now. Okay, so in terms of the equity markets, well, the indices are sort of playing out a bit of an interesting phase at the moment. We're outside of earnings season. We're still waiting for that to come round. That actually earnings season starts next week, so still in a little bit of limbo, but you could see with the huge amount of macro tier 1 data out this week that equity markets could get a bit spicy. But certainly at the moment, the Wall Street markets continue to be the positions that you want to be in on the long side if you're going to be long on equities. Certainly they continue upside. The S&P 500 found support nicely above its uptrend, nicely above the support between 1945 and 1955, and I think ultimately that will prove to be a very good buying opportunity. Now on the flip side of that, the European markets are under pressure. Top patterns completed on the FTSE 100 FTSE 100 has actually achieved its downside target of 66.40, but there's no real support or no major support until the next key low at 65.30. So we could even see a little bit more further downside in this. Again, on the DAX, we've also seen a top pattern complete below 9,600. That gave us a downside target of 9,427. And what we're seeing is just, again, a little bit of downside pressure in that. So the two key markets in Europe, DAX and FTSE, are still under pressure, but the Wall Street markets remaining pretty decent. Okay, so for gold, the gold price continues, as I said, a little bit of consolidation last week, but to be honest, there's a series of lower highs in place. All those lower highs are also coming below the key support, which is now turned into the resistance on that, following on from that break of the level at $1,240. That's all finding the ceiling now below that point. All these key lows are sort of pulling the gold price back towards $1,200 now, I think. That is the initial target, but also you've got the December low, the 1184.50 key December low, and I still think that is going to be tested in due course. Okay, so throughout this week, as I said, we've got a significant amount of data. We start on Tuesday with the Eurozone CPI data. We've already had the German CPI data coming in around about expectations, and I think what we're going to see is the Eurozone CPI data coming out on Tuesday, which significantly could have an impact on this market. The expectation is for 0.3%, sort of a slight bottoming of that inflation data, but certainly that won't help the euro in any way at all. You can imagine the euro will remain under pressure because the talk will continue to be over whether the Eurozone needs quantitative easing or not. Then on Tuesday afternoon, we've also got the US consumer confidence data. Again, consumer confidence in the States has been very strong recently, so that should be supportive of the dollar. On to Wednesday, we've got all the first of the month, so that means we've got all the manufacturing PMIs for China, Eurozone, UK, US, across the board, and a lot of volatility perhaps in these markets on Wednesday. Thursday is a big one. We've got the ECB monetary policy meeting. Again, as I said, the talk will always be throughout that as to whether we need quantitative easing or not, and I'm sure Draghi will be questioned mercilessly on that necessity, and especially bearing in mind the disappointing take-up of the first round of the TLTROs a couple of weeks ago. So that will be big. The big focus on Thursday. And on Friday we've got the service sector PMIs. Again, that'll be very important, but the big focus will be non-farm payrolls and non-farm payrolls report. Not only are we looking for the payrolls number, which came in last month disappointingly at 142,000, expected to improve this time around to well over 200,000, but the big takeaway from this report will once again be the labour force participation rate, and also the average earnings, because earnings growth is one of the key things that the Fed will be looking at in terms of whether it's going to be looking out for inflation down the line. 0.2% was the point last month. Again, this month is expected to be 0.2%, but certainly earnings growth needs to be seen before the Fed, or is likely to need to be seen before the Fed can tighten rates. So any sign of earnings growth will be deemed to be certainly dollar positive on Friday. Anyway, as I said, a load going on this week for you to get your teeth into, so I wish you good luck in your trading, and I will speak to you next week. Thank you.